We have Callum Henderson joining us today from Singapore. He's the head of global currency strategy at Standard Chartered Bank. And we welcome you in 2010, Callum. So let's talk about this U.S. dollar strength. This is pretty interesting. How much do you think the U.S. dollar will actually strengthen?
Well, I mean, the U.S. dollar was strengthening at the very end of last year. We think that 2010 will be a relatively tricky year for currency investors. 2009 was a dollar weakening year. You're totally right. It was very much a top-down perspective, a top-down bet on the view that risk appetite will come back strongly, and as a result, the US dollar will be used as the world's funding currency once again. This year we've characterized as a bottom-up year. In other words, investors will have to look for value. And they'll have to use a number of currencies to fund their purchases, not just the US dollar. In the first half of the year, we think the US dollar will do reasonably well. So you could well see further gains, particularly against the G10 currencies such as the euro, sterling, Aussie, Kiwi, CAD, which are quite overvalued still against the US dollar. But
yeah,
less
Cal,
so
what do you mean by
against
reasonably
Asia.
well? Let me just ask you, and when you talk about the US dollar, you said it will do reasonably well against the G10 currencies. What exactly is reasonably well? Because we're looking at the Bloomberg terminal, and it looks like StanChart's still calling for 145 versus the euro in the first quarter, which is pretty much where we're at right now.
Yeah, that's right. What we see is that the US dollar will strengthen further over the next few weeks and maybe over the next month or so. As I said, the very, very short-term perspective, technically, we're looking for, take euro as an example, 141 over the next few weeks, and then 137.5. Those are the next two levels to watch, and then a bounce. So it'll be a relatively tricky and a challenging year, much more so than last year, which was basically a dollar down year by risk appetite. This year will be much more challenging in terms of those assets that are valued within the emerging markets and also within the G10 markets.
That's pretty interesting. So let me just ask you again, 2010, as you said, a tale of two halves for the US dollar. That's pretty similar to what we saw in 2009. What is this pattern? Why do we keep seeing it for 2 consecutive years now?
Well, in 2009, you saw the dollar basically fall from March to December. This year, we think that the dollar will continue to rise against the G10 in Q1. And thereafter decline. The reason that it will rise is a combination of fears over the recovery and also expectations that the Fed will tighten further and faster than anyone else. We think that those expectations will eventually be disappointed, that it's one thing to withdraw excess liquidity, it's quite another to actually hike interest rates. And once the market realizes that, then we'll go back to a weak dollar trend that we're in on a multi-year basis.
Yeah, why do you think those expectations for a rate hike in 2010 will be disappointed? Because if you look at Fed funds futures, 60% of traders are expecting a rate hike to 0.5% in March at the March meeting. So what do you think that these investors and traders are seeing that you're seeing differently?
Well, I mean, first of all, there's a huge amount of uncertainty out there in the market. If you look at the forecasts for euro, just as an example, or indeed for the Fed funds, the market is very divided between those that expect a massive recovery and those that expect a double dip. We hadn't seen this kind of uncertainty for quite some time, and it reflects, a significant degree of difference of opinion across the market and across asset markets. Now, to come back to your question, we think that the market will be disappointed in terms of Fed tightening for a very simple reason: there is no inflation. We do believe that there will be a strong Q4 US GDP number, but that we will get a rebound in US growth without inflation because of the huge output gap that exists in the US. And therefore, once the initial shock of that number is analyzed and assessed by the markets, the market will realize that the Fed is not going to hike just because growth is rebounding, and that it will take inflation pressures to develop before the Fed sees it safe to start tightening rates.
Okay, Callum, give me year-end predictions for the U.S. dollar then. If it's going to weaken after gaining in the first half, what's going to happen to it at the end of 2010?
Sure. As we said, we think it'll be a relatively choppy year where the dollar is strong in Q1, consolidates in Q2, and then weakens in the second half of this year, which is the opposite profile to some out there in the market. But as I said, it's going to be a relatively tricky year. And in terms of ending the year, we think that it will end somewhere around 155, 160.
So really weaken against the euro. Let me just ask you this then. Why are you saying to sell the euro and the British pound right now against Asia ex-Japan currencies?
Well, the focus in Q1 is not so much on what the dollar does, but where value is. And we think that value is in Asia. We think that Asian currencies, for the most part, not all, but for the most part, are still significantly undervalued, and that growth prospects on a multi-month and indeed a multi-year basis are still very much here in Asia. So we like the Asian story. We're looking for different currencies to fund those purchases, and we like sterling and the euro. Partly because the euro is correcting, as we've seen over the past couple of weeks, but also partly because the fragility of the recovery in Europe as a whole is such that it compares with the very robust rebound that we're seeing in Asia. So we like short euro and short sterling against the leaders in Asia, such as, for instance, Korea and India.
All right.